I've had a lot of people ask me, so what are you trying to get out of having this YouTube thing that you're doing? So you get followers, business, whatever. And guys, let's just say where it started. It started for information. During, many of you probably weren't even looking at house at this point, but in 2020, when COVID hit and had such a massive influence on things, that did some things that required me to start getting on the phone and talking to people. So let's share a screen here with you real quick so you can see exactly what I'm talking about. This goes back to the day that COVID really impacted everybody. It was March 20th, massive impact. We saw a lot of negative coming in. Actually, it was earlier in the month of March 2020 when COVID created a monster problem for us. And let's just zoom a little bit differently here so you can see this. So this was early March, March 10th. Then we saw all this negative sell-off, all this movement. And then we started quantitative easing again, a big jump of quantitative easing to push it from this point down here, wherever that's landing is down here. This was the low point right there. It's kind of hard to see. You can barely see it, barely move. It's very, very volatile day. I'll see if I can open this up some more for you. It's an extremely volatile day. Swung all over the place from here way down to here and barely even moved. But there was a ton of trading that happened in that day. And then look what happened. The Fed dumped in over $1 trillion to get it up here and stabilize it. We're start moving at a normal, kind of normal way. But from here to here, you're talking about 20 days of complete uncertainty. We weren't able to lock loans to save our lives when that all happened. In fact, there was a lot of my competitors that say, "Hey, we just stopped taking calls." My team and I had to go about things different. Now, what's really interesting about this, well, what my team and I had to do, I'll go into a little bit more chart data here in a second. What my team and I had to do is we had to have a lock sheet created. Now, this is some adversity. It created a different process for us. So we created a lock sheet of all the files that need to be locked. Everybody was looking to try and lock their loans because of this extreme volatility. And then we had that in a shared drive where we could all see it. And I would just sit there all day long taking calls and I would just recycle the pricing, just, try to price the deal all day, just sit there, click it till bam, it was open and available to be able to lock. And then I sent an instant message out to everybody on my team that was licensed to lock and let's lock. And we were locking 50 loans at a shot till the window closed. That's how we stayed in business during COVID, because that month, nothing was happening for really anybody. We were getting deals done because we saw the necessity here of trying to have that heavy communication. So it created a whole process for us. Adversity creates things, right? So let's look back at the chart. So that's what happened. It actually gave us a whole new locking process and a way to follow and keep track of the locks with our clients. So that was just this little blip. That was $1 trillion. That little blip. Now let's zoom in on all of it so you can see what effect that had on the market as a whole, because it climbed out of it, right? Rates got better because we started this trend of capital going into the market, and it peaked out in 2020 December, kind of went sideways until 2021. So what we had a year, probably not even quite a year, about a year of the lowest interest rates we've ever seen. And this window, really, really low interest rates, you got into twos, and then they started quantitative tightening. And that's the evidence we see here. That quantitative tightening where it fell off. But if you look here, this looks like a little tiny blip on the radar. This was like a monster travesty what was happening during COVID. That movement, oh, we can't lock the interest rates. The interest rates spiked, and everybody's freaking the heck out. They spiked up to, I think they went up to like 6%, and the world was losing it. Well, we got down into actually probably low fours, high threes for real estate investors here, and then it fell off, and it continued to fall off, and it just continued to have this drive downward. And as a result of that, we end up finding these other levels that force us to go all the way back to look at the history of the mortgage-backed security and see where was the levels prior to government involvement. And quantitative easing right there. That's where we saw that. It forced me to look back on that and understand where is the pricing of these securities going to be. When we look at the pricing of those securities, then we end up right here as our ceilings, and it has proven to be a ceiling. Meaning, now let's look at this. I need to explain this a little bit more so you guys can understand what I'm looking at and why I'm looking at. And this was what this channel was designed for, to understand what I look at to help me decide whether or not it's a good day to lock or we float things out or where I think the market's heading. And it's all guess, guys. It's as good a guess as I can possibly make based upon the history of the security itself. Now, this security, what you have is every one of these sticks, it's called a Japanese candlestick, represents a day's trading. So it opens. I'm going to zoom in on this one because it's just a big sumbitch. Opens right here. And this one really stands out because this showed me a hell of a lot about the market that day. Opens, closes. So everything that's dark shaded, whether it be dark red, it means opened high, closed low. Dark green, open low, closed high. It means money flowed in. This means money flowed out. But money flowed all the way up to this level and receded back to this point of close. So people traded up to a point and then they sold out of their positions. Here, they bought in at a high level where it traded up at before, traded as high as it did, but then sold all their positions where it went back almost to the bottom the next day. What was a gap down open. So look, you had to have to zoom in more here so you guys can see this. So you can see it was a gap from where it closed and where it traded to where it opened. Traded up, closed the gap, and then continued to fall out below this level, worked its way down to some other levels, and then worked its way back up to test the levels again. And as you can see, every time it traded, it would go back and touch that level, which was the ceiling, which is the top of the value of the security the day they started quantitative easing in 2008. They announced quantitative easing here, traded to the top of quantitative easing exact same day. This has formed our ceiling. That's what I'm going to continue to work off of and believe is going to be our ceiling for rates, period, unless you have monster government involvement or some other monster entity. Now, we know recently Jamie Dimon talked a lot about what's driving the market. And he said the Fed really doesn't have a whole hell of an influence. $100 trillion a day moves through all the markets. Chase moves 10 trillion of that. Chase, one bank, 10%. That's massive. That's way more than what the Fed moves. Significantly more than what the Fed moves. So when you consider that, we the only thing really the Fed does kind of move because they channel a lot of the capital goes through them. So there's that. But when you start looking at where we are as these loans or these interest rates are concerned, I don't see us getting interest rates lower anytime soon. Look at this. We rode this downward channel. We worked our way out of it. We've been playing outside the channel, kind of reminiscent of this a little bit. I don't know if it's going to fall all the way back into or not. It's possible we may be out of this channel. This may be done. We may be retiring this channel like we did this one, starting a new one. Could come up. Look how it jumped up. If we do this, I'm going to see if I can draw some lines here for you. Let me see here. Yeah, I'll just do this. So if we do, if we draw, if it goes to here, right? How it popped out of there, created a whole new channel, worked its way back down, following a very similar trajectory. It's possible that we could have this do this again, come out up to here, and then start working its way down and creating a whole new channel. That's a possibility. So I personally believe that we're going to continue to see this same kind of volatility as far as a downward trend. So we could see it come up. It may come all the way up here again and then work a whole channel back down. So it's possible that we could see that. I'm not saying it is. I'm just saying that if history serves itself the way that it typically does, they'll work this channel for a ways, come up here, test it, work another channel down, test it, work another channel down. That's exactly how it's been playing, right? Tested it, worked the channel down. Tested it, worked the channel down. Tested it, worked the channel down, maybe test it again. That's my anticipation. If that is the case, then what we are seeing here is we're going to play with interest rates in this range. Now, what is that range? I would say the range is going to be, this is going to be my estimate, right? Let's go up to the top of this. Our range is going to be somewhere here to here, maybe a little lower. That's 316 basis points. What does that mean? 316 basis points worth of movement in this range. It could range at a long angle like this. That means that any time at the top of the range to the bottom of the range, there's about 3.125 to 3.25 points in cost. Meaning whatever the interest rate is that you are focused on, whatever interest rate you want, it could be maybe a par rate at one point when it's the top of the channel. It could be cost you 3 points at the bottom part of the channel. That's what you're mainly looking for, a 3 to 4 point swing in there. That's basically it. Interest rates, I think, will stay very similar to where we're at. Mid sevens for you real estate investors. When you get upset because you're getting some cost for a 6 or something like that, I've seen people with a 6.99 and get freaking upset about it. Are you kidding me? If you can get some of those things, grab it. And in reality, it doesn't freaking matter. If the property is paying for itself, and you have a tenant that's covering the cost, it shouldn't matter at all, guys. We've wrapped you guys up so much in thinking about cash on cash return that you put yourself in a bad spot and looking at it from really, really the wrong angle. Other things we got going on here. Let's take a look at the market this week. Yesterday we had the Empire State Manufacturing Index kicked out down from what was forecasted. They forecasted at 10.5, it's down to 16. So that's a pretty big swing as far as manufacturing is concerned. Negative swing. Retail sales. Prior sales were brought in up 0.1%. Now it's down. It's down. They revised it down 1/10. So that means there was a negative revision. So it was 100% swing on that one. Not really 100%, but 1%, a tenth of a percent off of zero. So off of par. Now, what we have also today is showing they forecasted down 8. It's actually down 9/10. So that's what's happening with retail sales. Exclude auto, and it's down. It was forecast to be down 1/10. It's down 3/10. So auto sale probably doesn't look like they're doing all that awesome right now. Import prices are flat. Export prices are down. Import prices excluding oil is up actually. Export prices, like I said, they're down. Capacity utilization is actually up pretty par. We're at 77.7%. It was forecasted to stay the same, but 77.4, so not far off of what that was. Industrial production is down quite a bit. So our production is down just a tad. But what we have coming up this week that's going to move the needle: housing starts, building permits, initial claims, and continuing claims. That's the thing that's moving the needle the most, from what I can see here, pushing it all over those charts, is the jobs claims. What's happening in our economy for jobs? If there's a lot happening, people are getting jobs, mortgage-backed securities are taking a hit, rates are going up because apparently people can pay it. If people are losing jobs, money's going into the mortgage-backed securities and going out of stock. So that's what we see. That's what's going on here. That's what I look at. That's why I look at it. That's why this started, just to keep bringing you information. If it blows up some viral thing, great. If I have 1 million viewers, great. If the person who's just looking to lock understands a little bit more and feels more confident and comfortable with lock and understand, guys, we're guessing at the best we can. Sit there and pitting people against each other, that's a fool's errand. Find somebody you trust, stick with them. That will lead you the best they can. At least somebody knows this stuff. If they don't understand how to share this with you, then don't be talking to that some bitch. Appreciate you. We'll talk to you guys on Friday.